Okay, then without further ado, I'd like to thank you all for joining us today to the first part of the Quarters Theory webinar. This is a series of webinars, by the way. The second one will be on May 17th, so make sure to attend that one as well. Today, what we're going to do, ladies and gentlemen, is we're going to do a little bit of an introduction, so to say, to the unique premise of the Quarters Theory. Some of you may already be familiar with what the Quarters Theory is all about. Some of you may not. And that's the idea of this webinar, to introduce you to the Quarters Theory. I will show you what the quarters are, how we derive it, what are the foundation, what's the foundation of the Quarters Theory. I'll introduce you also to the unique premise of this revolutionary foreign exchange currency trading method that I have created. We will talk about some of the applications of the methodologies of the Quarters Theory. For some of you who are not familiar with who I am, my name is Ilian Yotov. I'm probably familiar to most of you as the creator of the Quarters Theory. Some of you may have seen me or read my publications on a lot of financial websites, including our friends from FXStreet.com, whom I'd like to welcome as well today, and to thank them for organizing this webinar. Now, I'm the owner of allthingsforex.com, which is a popular Forex website, and you're more than welcome to come and visit it, allthingsforex.com, and also a website, a very unique website for trading and investing videos called tradertape.com. I'm also the host of a daily All Things Forex broadcast. Perhaps many of you already listened to it. You can log on to FXStreet.com to listen to the broadcast on a regular basis, and you can also, of course, access the program on our website, allthingsforex.com. My book, The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method, was published by John Wiley & Sons in January of 2010, and I would recommend that you, if you haven't picked up the book yet, pick it up from our website, allthingsforex.com, or simply going to amazon.com. You can find it there as well. I think the lowest price, however, is the one that we have on my website, allthingsforex.com. So what is the Quarters Theory? Well, the Quarters Theory is a very unique method that I have created. And it's a method that improves and simplifies the decision-making process in foreign exchange trading through the use of a very unique new methodology applied to the price behavior of currency exchange rates and also trend developments in the Forex market. It is very important to understand the Quarters Theory based on its foundation, because the foundation of the Quarters Theory is currency exchange rates, prices, and simple math. Price is the most basic, but also the most important unit of information available to a trader, in my opinion. Price represents the monetary value assigned to goods, services, and assets. In a financial market, price is the numerical monetary value of equities, commodities, or in our case, currencies and currency exchange rates. Price is measured, of course, by numbers, which are grouped as mathematical objects in a numeral system. Of course, we all use the decimal numeral system. Decimal numeral system is a positional system. It has positions for units, tens, hundreds, etc. The position of each digit conveys the multiplier, power of 10. To be used with that digit, each position has a value of 10 times of the position to its right. The decimal notation is familiar also to all of you. It is the writing of numbers in a base 10 numeral system which uses various symbols called digits for 10 distinct values to represent numbers. The numbers include real and whole numbers. Real numbers are the counting numbers, integers, rational numbers, irrational numbers, and also the so-called whole numbers. The whole numbers include every counting number And every whole number is also an integer. And every integer is also a rational number. The whole numbers are very important for my quarters theory, and pretty soon you will understand why. Because the decimal system is a base 10 numeral system, a value of 10 in one position is equal to a value of 1 in a position to the left. Here is familiar to everyone, the table of whole numbers. And you can see that the first number in each row represents a critical junction that marks the end of a previous set of 10 numbers and at the same time the beginning of a new set of 10 numbers. For example, the number 10 marks the end of the single digits set of 9 or 10 numbers, and then at the same time it marks the beginning of another set of 10 numbers, which is the so-called teens. Number 20 will mark the end of the teens, and we'll start a new set of 10 numbers, which we may call the 20s, and so forth. The quarters theory gives the name major whole numbers to the first numbers in each row of the table of whole numbers. So all of these first major whole numbers will be all of these first numbers here in a row of the table of whole numbers. So the major whole numbers will be 10, 20, 30, 40, 50, 60, 100, and so forth. Currency exchange rates are determined by comparing the numerical monetary value of one currency against another currency, measured in whole numbers. Currency exchange rates represent the currencies that are grouped in pairs. For example, euro versus the US dollar, Australian dollar versus the US dollar, and so forth. The first listed currency, as many of you know, is the base currency, or the unit that is compared to the second quote currency used to assess the value of the base currency. In the case of the euro-US dollar currency pair, it will be how many US dollars are needed of the quote currency to purchase one unit of the base currency, which in this case is the euro. In this case, in the Aussie dollar currency pair, the Australian dollar is going to be the base currency, the US dollar will be the quote currency. And when it comes to currency exchange rates, the precision that is needed to represent currency exchange rates requires the use of decimal whole numbers. These digits have a decimal point that indicates the start of a fractional part, whether it's 1.30, 1.31, 1.32, 0.80, 0.81, 0.82, and so forth. The digits are placed to the left and right of a decimal point in order to indicate a number less than or greater than 1. For example, an exchange rate of $1.30 for the euro-dollar pair would indicate that the value of 1 euro unit is greater than 1 US dollar. On the other hand, an exchange rate of 0.80 or 80 cents would indicate, for the Aussie versus the US dollar currency pair, will indicate that the value of 1 Australian dollar unit is less than 1 US dollar. The major whole numbers, when we use currency decimalization, can easily be distinguished in currency exchange rates even with the decimal point in their numerical representation. The quarters theory considers the parity level of 1-for-1 exchange rate as the benchmark major whole number in currency exchange rates. Here are some examples excuse me, of major decimal whole numbers when it comes to currency exchange rates. So the quarters theory will consider as the benchmark 1-for-1 level exchange rate as the benchmark major whole number in currency exchange rate. So, for example, an exchange rate of exactly $1 for the euro-dollar pair would indicate a parity value of $1 for 1 euro, right? But then if the exchange rate begins to rise and we get to see, let's say, a 30-cent increase above parity, then obviously at that point we can say that we have reached another whole number, or a major whole number at $1.30. If we get another increase, we'll get to $1.40, $1.50, and so forth. You get the idea of what the major decimal whole numbers are and how we can recognize them with the quarters theory methodology. And also, these major decimal whole numbers are very, very important. Why? Because they mark the beginning and at the same time the end and the beginning of a previous set of regular whole numbers, not the major decimal whole numbers. For example, $1.30, between $1.30 and $1.40, we would have $1.31, $1.32, $1.33, and so forth. 9 regular whole numbers. Currency decimalization has caused one unit of the main currency to be divided into 100 subunits. For example, 1 euro, which is the main unit, or $1, have been divided into 100 cents. 1 Swiss franc is divided into 100 centimes. 1 pound divided into 100 pence. Currency exchange rates, because the need for even more precision when it comes to currency exchange rates, they're decimalized even further by not only dividing the main unit, but also the subunits. So 1 cent, for example, is divided into 100 additional subunits called price interest points or pips. In some currencies, like the Japanese yen, for example, the main unit is divided into 100 additional subunits, 1 yen divided into 100 pips, for example. The quarters theory recognizes that when represented in terms of pips, the distance of 10 cents, 10 pence, 10 centimes, 10 yen, and so forth, between each two major whole numbers establishes well-defined ranges of exactly 1,000 pips. Each one of these 1,000 pip ranges between two major whole numbers has 9 other whole numbers. Increments of 1 unit, whether that is being 1 cent, 1 penny, 1 centime, 1 yen, etc., equals to 100 pips. Another very clearly defined, established range of 100 pips separating each two whole numbers. The distance between two whole numbers define a smaller range of exactly 100 pips. So let's consider this example. Let's say we take a look at the 1,000 pip range. If we were to look at the current 1,000 pip range, for example, that the euro-dollar exchange rate is currently trading within. What are the two major whole numbers that would define that 1,000 pip range? Currently, the euro-dollar currency pair is trading at a little bit below $1.35. So it is trading within the 1,000 pip range between $1.30 and $1.40. And if the exchange rate is between $1.34 and $1.35, then it would be also within the 100 pip range between the whole numbers of the $1.34 and $1.35. From this illustration, you can see that each 1,000 pip range can also be divided into smaller 100 pip ranges between the individual whole numbers within a 1,000 pip range. So what are the quarters and how do we actually derive them? Many of you will know that a quarter is a 1 or 4 equal parts of something. It could be 1/4 of an hour, 1/4 of a kilo, or a pound, or with money, it is the US or the Canadian coin that is equal to 1/4 of a dollar. The quarters theory focuses on the 1,000 pip ranges between the major whole numbers in currency exchange rates and divides these ranges into 4 equal parts, or 4 large quarters. Each 1,000 pip range contains 4 large quarters, and each large quarter has exactly 250 pips. The numbers that mark the beginning and the end of each large quarter are given the name large quarter points. The large quarter points that coincide with major whole numbers are also called major large quarter points. In this particular example, of course, the major large quarter points, they represent critical junctions that signal the end of a previous and at the same time the beginning of a new 1,000 pip range. The exact half point of each 1,000 pip range also coincides with a large quarter point, and it is called the major half point of the 1,000 pip range. In this example, once again, we're looking at the 1,000 pip range between $1.30 and $1.40. When we divide that range, we will get 4 large quarters of 250 pips each, between $1.30 and $1.3250, $1.32 to $1.35, $1.35 to $1.3750, and $1.3750 to $1.40. Major half point coincides with the large quarter point as $1.35, and $1.30 and $1.40, the major whole numbers that define the 1,000 pip range, are also called major large quarter points. The 100 pip ranges, we said, are the ranges between 2 whole numbers. Those are also very well clearly defined ranges, and they can also be divided into 4 equal parts, or 4 small quarters of 25 pips each. Let's take a look at, for example, the 100 pip range between $1.30 and $1.31. If we divide that 100 pip range, we will get 4 small quarters from $1.30 to $1.3025, $1.3025 to $1.3050, $1.3050 to $1.3075, and $1.3075 to $1.31. The small quarter points, $1.30 and $1.31, $1.3025, $1.3050 is also a half point of that 100 pip range. And we have $1.37.5 and $1.31. So this is the example of 100 pip range there. That also gives you the small quarters. The quarters theory offers universal, constant, and familiar price ranges that allow quick and precise price analysis of any currency pair. No matter what the exchange rate, we can analyze very quickly any currency pair. The quarters theory provides traders with the ability to locate in a matter of seconds the exact 1,000 pip range, the exact large quarter of 250 pips that the exchange rate is trading within, and also with even further precision, we can zoom in, so to say, and find the exact 100 pip range that the exchange rate is trading within, and even with even more precision then, we can zoom in even further and find even the smallest quarter of 25 pips that the currency exchange rate is trading within and is positioned at any given time of our analysis. The following is an example of a price analysis that we can quickly utilize by what I have shown you already. we can take a look at the exchange rates of three currency pairs using the methodology of the quarters theory. At, let's say, particular exchange rate, let's imagine that the euro-dollar exchange rate at this point, as we speak, is at $1.2345. Okay, can we quickly find out where the 1,000 pip range that this exchange rate is trading within? That would be the 1,000 pip range between $1.20 and $1.30. Which large quarter is the currency pair's exchange rate, the euro-dollar, at the $1.2345 trading within? That would be the large quarter between $1.2250 and $1.25. Now let's zoom in even further. What would be the 1,000 pip range? At the $1.2345, the euro-dollar currency pair is trading between $1.23 and $1.24. Those are the whole numbers that define the 100 pip range there. So if we zoom in even further, at $1.2345, what would be the small quarter of 25 pips that the euro-dollar exchange rate in this example would be trading within? That would be the small quarter between $1.2325 and $1.2350. Let's, for example, take a look at the dollar versus the Japanese yen at, let's say, 96.78 yen. What would be the 1,000 pip range that the exchange rate is trading within in this example? That would be the 1,000 pip range between 90 and 100 yen. Thank you, by the way, guys, for the feedback. I appreciate that. It's going to get even better. Stick with me here. I'm just giving you and laying down the basics right now. It gets a lot more interesting. So I got a lot more to show you, but thank you for the feedback. The dollar versus the Japanese yen, let's say, 96.78 yen. That will be the 1,000 pip range between 90 and 100 yen. What will be the large quarter of 250 pips? That will be the large quarter between 95 and 97.50 yen. What about the 100 pip range? The whole numbers between 96 and 97 yen. How about zooming in even further to see the smallest quarter? That will be the quarter at 96.78 yen. That will be the small quarter between 96.75 and 97 yen. I'm getting a question based on the quarters points. What are the methods for a trade entry? Let's not get ahead of ourselves right now. Let me give you the basics right now, guys. Let's practice a little bit because I know this is very new to a lot of you. And I just want to spend some time as far as introducing this in today's webinar. And next month, we're going to talk about practical applications of what I'm showing you. Okay? Let's take a look at the example with the Aussie versus the US dollar at 0.7134 cents. That will be the 1,000 pip range between 0.70 cents and 0.80 cents. What will be the large quarter then? At 0.7134, that will be the large quarter between 0.70 cents and 0.7250. What about the 100 pip range? At 0.7134 exchange rate, that will be the 100 pip range between 0.71 and 0.72 cents. And then the smallest quarter would be 0.7125 and 0.7150. I would suggest, if you're interested in the quarters theory, that you do this type of a practice from now on so that you can get even more familiar and begin to recognize these 1,000 pip ranges, the particular large quarters that the currency exchange rate is trading within, and the 100 pip ranges as well as the small quarters that a currency exchange rate is trading at any particular time of your analysis. The premise of the quarters theory is a very unique premise. The quarters theory is based on the premise that the daily fluctuations of currency exchange rates are not random, and that currency exchange rates fluctuate in an orderly manner between the large quarter points within each 1,000 pip range defined by two major whole numbers. With the quarters theory, I proposed that every significant price move in currency exchange rate takes place from one large quarter point to another large quarter point in gradual increments of 250 pips, which is the range between two large quarter points. The quarters theory challenges the notion that the financial markets are chaotic and that market prices are random. Especially when it comes to currency exchange rates, I argue that there is an actual organization when it comes to daily fluctuations of currency exchange rates, and that there is no chaos and that there is no randomness, but rather smooth, fluid price moves between these large quarter points of each 1,000 pip range. The quarters theory provides you with a roadmap. The 1,000 pip ranges divided into equal parts or four large quarters of 250 pips each. The quarters theory establishes the route with a very distinct starting point and a very clear destination. Every significant price move begins at a large quarter point and also ends at a large quarter point. The large quarter points serve as constant, never changing support to resistance levels, as well as familiar, invariable price targets. A bullish price breakout above a large quarter point is expected to target the large quarter point above. A bearish breakout below a large quarter point is likely to challenge the large quarter point below. When a targeted large quarter point is reached, a large quarter of 250 pips is considered as completed. If prices fail to complete a large quarter, the unsuccessful completion of a large quarter usually causes a reversal that takes prices back toward the preceding large quarter point. And here is the beauty, ladies and gentlemen. The outcome of both events, whether a large quarter is completed or whether it is not successfully completed, the outcome of both events always leads to a price move that targets a familiar price level. What would be that price level? A large quarter point. The repetitions of the series of large quarter completions from one large quarter point to the next, or reversals back toward the preceding large quarter point as a result of unsuccessful completion of a large quarter, regularly manifest themselves as recognizable price patterns in the daily fluctuations of currency exchange rates. Let me repeat that. The repetitions of the series of large quarter completions from one large quarter point to the next, or reversals back toward a preceding large quarter point, regularly manifest themselves as recognizable price patterns in the daily fluctuations of currency exchange rates. Here is an example of what I'm talking about here. Let's take, for example, the dollar-Japanese yen exchange rate in a period of several months, February, March, and April of 2009. We see the price entering the 1,000 pip range by breaking above the large quarter point. That's also the major large quarter point at 90 yen. Note that the move there takes us to challenge the large quarter point above. What is that? The large quarter point at 92.50. We move toward it. We don't exactly reach it. That's an unsuccessful completion of the large quarter. And then we pull back to the preceding large quarter point. We do not break below the preceding large quarter point. And as a result of that, we make another attempt to complete the large quarter by targeting 92.50. On the second attempt, that large quarter of 250 pips between 90 and 92.50 yen is successfully completed. When prices break above 92.50 large quarter point, they start moving to target the large quarter point above. We get a little bit of a hesitation, and then we continue forward to target the major large quarter point at 95 yen. When prices break above 95 yen, we get to see a move targeting the large quarter point above at 97.50. We complete the quarter, and then prices break above 97.50, making an attempt to move to the 100 yen level. Unfortunately, prices stop in the middle, and we get a familiar price pattern which takes prices back to another familiar level. What was that? The preceding large quarter point at 97.50. Prices find support around 97.50 large quarter point, and then make another attempt to target the 100 yen major large quarter point. There are several attempts here in this example where the major large quarter point at 100 yen is not successfully completed. This is 3 months, a chart, 3-month chart of the dollar-yen currency pair. During the entire 3 months, the price action is taking place within the 1,000 pip range between 90 and 100 yen. After several unsuccessful attempts to complete the large quarter between 97.50 and 100 yen, as you can see here, we're finally seeing prices dropping below 97.50 large quarter point and making a move to the major half point, the large quarter point at 95 yen. Finding support around that area, prices start moving above 95, potentially again targeting 97.50. The quarter is completed, we make a move, we hesitate, we pull back to the preceding large quarter point, and then finally, by the end of March of 2009, we get to see a move that completes the large quarter to 100 yen. So once again, these are recognizable price patterns that will manifest themselves for those of you who have not recognized them until now. Now you have been introduced to the premise of the quarters theory, and you can see these recognizable price moves on a daily basis. Now, what's even another example that I wanted to show you is that prices fluctuate obviously not only between the large quarter points, but they also fluctuate in between the small quarter points that are within each large quarter of 250 pips. Each large quarter of 250 pips will have 10 small quarters of 25 pips each. So there's also gradual fluctuation that is occurring there between the major whole numbers and the actual whole numbers and the large quarter points of each large quarter of 250 pips each. Let's, for example, take a look at the 1-hour chart of the dollar versus Canadian dollar currency pair. Price action takes place between large quarter point, $17.50, and potentially targeting the large quarter point below at $1.15. Here is that 250 pip large quarter between $1.15 and $17.50 divided into 10 equal parts, or 10 small quarters of 25 pips each. As you can see, there's a series of down and up moves here that eventually produce the completion of the large quarter below $17.50 and $1.15. Now, speaking about completion of the large quarters, when do we consider that a large quarter has been successfully completed? Perhaps many of you have not noticed these patterns and the daily repetitions of these patterns because the large quarter points are actually disguised in most instances. You probably have not often seen this because price volatility has a tendency to conceal the actual large quarter points, making them difficult to recognize. Although in some cases, price moves can stop exactly when a large quarter point is reached, exactly up to the pip. In most instances, prices either surpass the exact number representing a large quarter point, or they stop short from it. In periods of high volume and volatility, prices may move beyond the exact large quarter point, while in periods of low volatility and volume, prices may stop short of it. This is a development which I call overshoots and undershoots. When prices surpass a targeted large quarter point, they overshoot it, either above or below. When prices, in this example, you will see an undershoot right there, because prices surpass the large quarter point at $1.15. In this particular example, the large quarter point is not reached exactly up to the pip. Prices come short from it, and that's what I call undershoot. These overshoots and undershoots disguise the actual large quarter points. And it's disguised under a veil of random numbers, creating the perception of chaos, the perception of lack of purpose, and lack of organization in price fluctuation. It makes these large quarter points often unrecognizable. The quarters theory, in order to help you recognize all of these large quarter patterns and price fluctuations, the quarters theory designates the range of one small quarter of 25 pips above or below a targeted large quarter point, and as soon as a price is reached that falls within 25 pips or one small quarter from a large quarter point, then we consider the large quarter as successfully completed. Why do we do that? Because we realize that it's practically impossible in most instances for price moves to stop exactly at a large quarter point. You will not, in most instances, see a particular large quarter point registered exactly up to the pip, let's say $1.15, 1.1500 or 1.1750, $17.50. In most instances, you're not going to see these kind of prices registered as a high, low, open, or close in a particular time frame. But as long as prices reach a number within 25 pips from the targeted large quarter point, we consider the large quarter as successfully completed. Here is an example. The undershoot area of the large quarter point in this example would be the 25 pip small quarter between $17.25 to the large quarter point at the $17.50. Once again, that is a small quarter of 25 pips. If we were looking for prices to complete this quarter, we would not request from the market to give us exactly a move that stops at $17.50 up to the pip. As long as prices reach that undershoot area and they register a number as an open, high, low, or close that falls within 25 pips or one small quarter from the targeted large quarter point, we would consider the large quarter as successfully completed. Here's the move here that takes us to the large quarter point at $1.15. Here, as I mentioned earlier, we have a little bit of an overshoot, meaning that prices have overshot below the large quarter point at $1.15 and have entered the so-called overshoot area, one small quarter of 25 pips between $1.15 and $14.75. There's a lot more. Yes, I'm actually monitoring the discussion there, and there were a couple of guys that were writing in Spanish, and unfortunately, my Spanish is very limited. So if you have any questions, write them in English. And again, guys, this is an introduction to the quarters theory. It is impossible to build upon any further unless you understand these basic premises. Okay? So Please be patient. Overshoots and undershoots can occur not only around the large quarter points, but also when price moves target whole numbers or important support resistance levels in an attempt to produce breakouts. The quarters theory requires a price move that is larger than one small quarter of 25 pips above or below, for bearish price moves that is, an important price level in order to qualify it as a decisive breakout. Why is that? Have you actually seen prices target a particular resistance or support level and moving a little bit above or below it, only for you to find out what you thought looked like a breakout is followed by a sharp reversal in the opposite direction that often triggers a lot of your stops? Well, this is one of those rules that I created with my quarters theory, that if prices surpass the targeted large quarter point or support or resistance level and they overshoot it or they overshoot it by up to 25 pips, I still do not consider that as a decisive breakout. This is a way for me to recognize what a decisive and undecisive breakout is. And this is a way also that I have found helpful to prevent a trader from becoming a victim of a head fake, or what could be a potential fake breakout that is immediately followed by a reversal in the opposite direction and could trigger a lot of trader stops. So what is the successful completion of a large quarter? Once again, this is a move from a large quarter point. This example gives you the euro-dollar pair. From the large quarter point at the $1.3250, you can see the price moving above it, find support around that large quarter point at the $1.3250 to a targeted large quarter point at the $1.35. Excellent question comes from Joe, who's asking, what makes the quarter points so important? What makes the quarter points important and validates them is the fact that we all use the base 10 numeral system of our world. And because currency exchange rates are also represented in numbers, fortunately, the daily repetitions of these price patterns is what makes the large quarter points important. Support and resistance levels, pivot points, are also very important to pay attention to. But one thing that I have noticed from my experience, and you would agree with me, is that support and resistance levels and pivot points vary. They change. Today we have one support, then we break it, then we move to another one, etc. Another question, why not just use Fibonacci and Gann? Fine, let's use that. But Fibonacci levels also change. They vary. The large quarter points are reliable price levels that never ever change. No matter what the exchange rate and what the numerical representation of a currency exchange rate is. The large quarter points do not change. You can always find them by dividing the current 1,000 pip range that the exchange rate is trading within into 4 equal parts, and you can see what the large quarters are there. And then you have a roadmap. If you follow the quarters theory, you would know that prices are going to fluctuate, and every significant move will occur from one large quarter point targeted another large quarter point. And if that large quarter point targeted is not reached and the large quarter is not successfully completed, then we could see the development that I explained earlier. A price reversal that takes prices, and if you're guessing where, you don't have to guess anymore. Back to a preceding large quarter point where the initial move had already started. Here's an example. Let's take a look at the euro-dollar currency pair. We will see a move here from the large quarter point at the $1.3250, potentially targeting the large quarter point above at the $1.35. We're seeing this is again a daily, a 1 hour chart that spans into 3 days time frame. book is asking, does the quarters theory also work in other markets? I have tested it with equities. Options prices are also in $2.50 increments, as many of you know. So you're welcome to see if you can discover these price repetitions and fluctuations there with equity prices, futures, yes, absolutely, futures, options, etc. Now we're going to take a look at this example that shows you the large quarter move from the large quarter point at the $1.3250, targeting $1.35. Notice the hesitation here. Several attempts. First one here, prices stop at certain level, pull back, making another attempt, fail to continue further, and especially fail to reach a price within a targeted large quarter point at the $1.35 by entering at least the undershoot area, the small quarter between $1.3475 to $1.35. After the two unsuccessful attempts here to complete the large quarter, we get to see a move that takes prices back, targeting the preceding large quarter point at the $1.3250 as a result of the unsuccessful completion of the large quarter of 250 pips there. So this is the introduction that I wanted to show you to the large quarters theory today. You can listen to my daily program. I call it the All Things Forex broadcast. It's a live program, 1 hour, Monday through Friday from 1 to 2 p.m. Eastern time every day. And you can listen daily at allthingsforex.com, or you can also listen at FXStreet.com. I publish it there, as well as about 10 other popular Forex and financial websites. And do not forget to tune in to the webinar in May, on May 17th, Monday, May 17th at 11 a.m. Eastern Standard Time, when we're going to discuss and we're going to build a little bit more on what I showed you today. We'll talk about important price levels within the large quarters, not just the large quarter points. We're going to talk about analyzing price behavior using the methodology of the quarters theory, recognizing signs of strength or weakness. I'll introduce you also to the 3-day rule of the quarters theory and some of the practical applications of the quarters theory methodology in today's Forex market. In the next, yes, we can do real charts to answer your question in next webinar, where you can find some more info. And do I have any material? Excellent question. You can find more information on allthingsforex.com. And of course, you can go to allthingsforex.com to order the book, The Quarters Theory, in which I explain in much detail what I started talking about today. And also, of course, you can go to Amazon.com to order the book as well. And make sure to listen to the live daily broadcast also. Before we wrap things up, let me just give you a little bit of a taste here. 1 second. Of what we're going to talk about in the upcoming webinar. All right, let's see here. Because a lot of you asked for charts, let me give you one of the most recent examples here. Dollar against the Japanese yen. This is a daily chart and an example of a large quarter trade. Here's the large quarter point, 90 yen, 92.50 large quarter point, and 95 yen large quarter point. You can see the settling here. Where is the selling starting at? You get the range bound trading around 90 yen level. We break. We move up. What's the next price move that the quarters theory proposes. Every significant price move takes place from the large quarter point, targeting another large quarter point. In this case, it's 90 yen, targeting the large quarter point at 92.50. There we have an example of what I call a large quarter trade. May 17th, ladies and gentlemen, Monday, May 17th, 11 a.m. Eastern Time. I'd like to thank you all very much for attending today's webinar. Thank you so much for your interest in the quarters theory. And again, if you'd like to find out more, look for this book cover on allthingsforex.com or amazon.com. Thank you again for attending. I appreciate it, and I'm looking forward to seeing you all during my All Things Forex broadcast or during the next webinar on Monday, May 17th. Thank you and happy trading, everybody.